Hey guys, Stockaholics, thanks for being here today. I consider myself largely to be a contrarian investor. One of the types of stocks that greatly appeals to me because of this investing style are cyclical stocks. There are certain patterns that you can exploit being a contrarian investor. However, I feel that there's a lot of people who get a lot of this stuff wrong. There are some people that I know personally that I'm making this video for. There are a lot of the people that I've noticed through the views and subscribers who get very interested in a lot of my ideas in cyclical stocks once they have already gone through explosive rallies. I don't think that investing generally after a certain very large rally is usually in cyclicals is usually a good strategy. And I have also seen some YouTubers, content creators who I think are some very intelligent people who also get a lot of these things wrong in various ways, whether it be valuations, timing, etc. So I wanted to take some time for, and I'll probably link this video for whenever I make a video in the future talking about a cyclical stock or commodity. I wanted to take some time to kind of break cyclicals down. So who cares? What's the point of learning all this stuff, right? Okay, so first of all, cyclicals have the power to create tremendous wealth if you get it right. You know, if you understand a cyclical industry and you get some 2, 3, 5, 10 baggers out of that, you don't need to get many of those to have some kind of life-changing wealth, right? However, if you don't put in the effort and you don't understand them and you have no idea what you're doing, cyclicals have the power to do the exact opposite. They have the power to destroy 20, 30, 50, 90, 99% if in the case of tankers, if you don't know what you're doing, if you get it wrong. But there are predictable patterns, I think, that can help you get it right more often than you get it wrong. So if you have the appropriate sizing, you measure the amount of risk and you diversify enough across your portfolio, there is tremendous opportunity in this space. And I think that if you really understand what you're doing, you have the potential to beat market returns. And that's not something easy to do. All right, so this is the complete guide to cyclical investing. I wish I had known sooner. Probably an hour-long video in which nobody will watch. I'm going to put timestamps at different points in this video for all of the things I'll be talking about this video. If you feel like there are certain things that you would rather know or certain things you're not interested in, you can go to those parts that interest you most. So in the beginning, I'll be talking about what they are. I'll be breaking down cyclicals. I'll be breaking down what are some good and what are some bad cyclical companies or industries. We'll get into we'll get into a guide on cyclical investing, a very simple guide with 5 main points. Peter Lynch will introduce that to us. Then we'll talk about learning businesses, knowing what you own. We're going to look at some buy and sell signals, particularly in the form of the media. We'll be learning about managing our emotions, both from the market and yourself. In terms of the market, I mean observing other people's emotions. And number 4, we'll be talking about valuations, different ways that we can value cyclicals. And the last thing I'll be talking about are some buying and selling strategies for cyclical stocks. Okay, so what is a cyclical stock or a cyclical company? First of all, one of the ways that you can identify a cyclical company many times, not always, is based on this pattern. So if you see these large wave patterns over time in the company and they repeat over long periods of time, chances are those are a cyclical company. What these companies are they go through periods of large earnings, and then they also go through periods of lean earnings, or in many cases negative earnings, right? So what this leads to is investors ebb and flowing in and out of a company, and these aren't due to any fault of the company. These are due to forces that are largely out of the control of the company. So a lot of these cyclical companies are based on what I have on my screen here. This is the business cycle. So in a business cycle, there are peaks, recessions, depressions, and expansions. These are based on the economy of a country, or in many cases, the economy of the entire world. In 2008, there was the global financial crisis. During that time, many places in the world went through a recession, or in many cases, a depression, when times were very bad. What this leads to is lower than average incomes for a lot of people. And what this leads to is a lot of these people not being able to, who are affected by these things, not being able to spend money on things that they might want. They can still spend money on a lot of things that they need, but they can't spend money on discretionary items. So some examples of that might be the airline industry. So if they lost their job or their business just went under, they won't be able to go out and buy plane tickets. They might not be able to go travel on a vacation, go visit their family somewhere, wherever, right? So this is an example of a cyclical industry, the airline industry. Another one, when times are lean, the people may not go out and buy a new car. So it's a big ticket item. They won't be, when times are rough, they'll say, well, maybe I'll hold off buying a new car, or maybe I'll buy a used car or whatever, right? So new auto sales, they go lower, and the auto industry tends to suffer, right? The thing is, whenever these business cycles get into these recessions or these troughs or these depressions, things have always turned around. It's a natural rhythm. It's a cycle. When there's a cycle of death, these companies that aren't very strong, they go broke, and it leads to an undersupply. Healthy businesses survive, and eventually new businesses form, and the economy grows again. This leads to an expansion phase. So what that also leads to is people have higher than average income, and they can go out and they can buy those discretionary goods. And these lead to periods of time when these cyclical companies have tremendous earnings. They have higher than average earnings, right? So a lot of cyclical stocks based heavily on the business cycle. Now, there can be cycles within the business cycle as well. So a lot of cyclical companies, there is not a lot that differentiates them. For example, commodities. If I am a corn farmer and I have a plot of corn, and I can sell corn at a current price, I cannot usually dictate the price of corn. Now there's a neighbor, let's say he's a couple blocks down, and he's got a couple acres where he grows corn too, right? We're producing the exact same product. So the only thing that really, there's nothing, in terms of the product, there's nothing that differentiates us. The only thing that differentiates us is the price that we can profitably sell this thing at. And usually it's something that is out of the purview of that producer. So and these can also be affected by the business cycle if these kinds of businesses can remain profitable. During these depressionary phases, a lot of these kinds of no moat kind of companies go bankrupt. So let's say that corn farmer, he can produce the corn profitably at, I don't know, $1 for, I don't know what corn goes for, $1 for a kernel of corn. And let's say that the neighbor can produce it profitably at 90 cents for a kernel of a cob of corn or whatever, right? The guy who can produce it cheaper is more likely to survive in the long run through these depressionary phases, and thus be in existence during these expansionary phases and derive profit from it. Okay, so on my screen I have 4 examples of cyclical companies, and some of these, their price charts, you may be able to easily identify some of the cycles, and some of them you may not. So I'll kind of go through these companies and try and break down some of their cycles to the best of my ability. In the top left, we have a company called Freeport-McMoRan. I always struggle with this name. This is a copper producer. On the top right, I have a company called Toyota, a very well-known company, automobile producer. Bottom left, I have Lufthansa. This is an airline company. And bottom right, I have Frontline. This is an oil tanker company. Okay, so let's start with Freeport-McMoRan. I think one of the best ways that you can define the cycles that you see in Freeport-McMoRan is from something called the super cycle in commodities. From 2003 to approximately 2008, there was a very large expansionary phase in the world economy. There were several countries that had massive increases in copper demand, along with all kinds of other commodities. These are usually referred to as the BRICS: Brazil, Russia, India, and China. Now, for copper demand, there were increases in demand, but supply takes a long time to catch up for a commodity like copper. I can't just open up a mine down the street, pick some copper out of the ground and say, okay, problem solved. You have to find the stuff, first of all. People have to go out, survey, drill. That costs money. And then you have to, determine if the grades are profitable enough to produce. Then you have to get permitting. There's a lot of environmental impacts. There's governments, regulations. And then it takes time if you can pass all of those things, you have to actually build the mine, which takes time too. So for even when these guys probably realized there was an undersupply of copper at the time, it takes a long time for these guys to be able to bring new production online. But in 2008, as you can see here, a lot of things changed very fast when the recession happened. Now, at the same time, eventually this turned around. In 2009, the economy went through another expansionary phase. Things started turning around. But a lot of the things that happened over here led to problems for the next decade in this cyclical over here. And this is an example of a very long cycle. So because the prices were so high so long in copper, it led to increased mine production. And then when those mines finally came online, a lot of mines came online all at once, and it led to an oversupply of copper, right? And these mines don't just like it takes a long time to build them, they don't just disappear overnight either. So there was a large supply of copper on the market, right? I've talked extensively about what I think this is. I don't think that this is the same as these other things. If you're interested in that, go and check out some of my other copper videos. Okay, so Toyota. So what's cool about Toyota is that unlike some of these other cyclicals over here, it is actually an amazing company. It retains some value through each of these cycles. A lot of cyclicals don't. So Toyota, awesome company. Okay, but you can see these kinds of ebb and flows, right? What you really notice is that earnings in these companies, especially these automobile companies, they tend to peak towards the end of an economic cycle. So there's a long period of time when people are doing very well. And then as they've built up these incomes for long periods of time, then they go out and they buy an automobile. And then at the same time, they go out and buy a lot of automobiles. Toyota is awesome because most of the time, I don't know if this is still true, but when I was looking at it in the past, they have higher than normal margins for other automobile producers. So what this means is that they can produce high quality products cheaper than a lot of their competition. So over time, they retain value through each of these cycles. But you can see that if your timing is very bad in one of these companies, you can lose 50%, even though Toyota is an awesome company. But if your timing is very good, you can gain, I don't know, 100, 200% on an investment, right? Okay, Lufthansa, another cyclical company. Just like Toyota, when people have higher than average incomes for large periods of time, they go out and spend money on discretionary items or services. And in this case, that is leisure travel, right? So during these periods of time when the when the cycles are doing very well, their earnings go way, way, way up. The thing about airlines, though, there's not a lot of things that differentiates them. Like most cyclicals, they produce more airplanes, more businesses open up, and ruins the party for everyone. Eventually, there's a recession or something bad happens where people have or there's just too many airline companies competing with each other, and earnings go sour, right? Now, this is the last one here. This is an oil tanker company called Frontline. Sometimes the cycles, and this is what really attracts me to a lot of cyclicals, is the potential gain on an investment can just be astronomical. So for example, if you had invested in Frontline in 2003, let's say that you noticed that the super cycle, these things would be very hard to identify in the present and during that time. But let's say that you could identify some patterns and you could notice that oil demand is increasing, and an investment in Frontline would make sense, right? This thing just absolutely went bananas. This thing is almost a 100 bagger if you got in from the bottom to the high in this shipping company, right? That's why I'm so excited to follow oil tankers, by the way. Is just the potential for just astronomical returns, right? Now on the flip side though, once that cycle had ended, there was and to this day remains a poor market for oil tankers. So what had happened during this ramp up phase from 2003 to 2008, during this whole time here, there were tremendous amounts of oil tankers being ordered and built to kind of match this demand, right? The party only lasts so long. Eventually the recession hit, and there was just an overabundance of these tankers, and tankers last a long time, right? So you can build a oil tanker and the thing can last for 20 years, right? So when there was this excess supply, there's huge amounts of these oil tankers built during this time. In many cases, a lot of these things are still delivering oil to this day. Okay, so what makes a good cyclical business? So an example of a good cyclical business was one thing we saw in the last slide, Toyota, right? But here's some of the things I like to look for cyclicals. Companies that usually tend to retain value through some of their cycles, right? So first of all, I like to see low debt, or at least lower debt than a lot of their competition. So a company with high debt is less likely to survive through a cyclical downturn. So if the business cycle turns, we go from that expansionary phase to a recessionary phase. If they've got a lot of debt, that's likely to either lead to a lot of capital raisings, dilution to kind of keep the lights on in that company, or the company just goes completely defunct and bankrupt and you lose your entire investment on that thing, right? One of the things I really like to see, but this isn't always something that you're going to find in all cyclicals, is better operating margins than their competition. So if these margins can stay positive throughout cycles, they are likely to be a good cyclical business. And this business is likely to increase value through the cycles, right? So even if you get it kind of wrong, let's say you're a little bit too early or a little bit too late in terms of investing in your cyclical, if that company has a long-term upward trajectory, you'll probably be okay. So I like to see better operating margins than a lot of their competition, right? This one is very important to me, and this might seem kind of obvious, but I know a lot of business owners, I think, don't think about their business in terms of the business cycle. They get stuck in the minutia of running their business. They think about, how can I retain profit? How can I keep shareholders happy? And you have a lot of shareholders don't understand these cycles either, right? So for a successful management in a cyclical company, you need some very, not only competent management, but you need confident management too, right? So I like management that makes prudent decisions based on the perceived location in the business cycle. So some of the things I like to see, they're saving cash during the strong times. So when times are very good, they're adding to that balance sheet. They're not going out and taking out new debt. They're paying off debt. They're keeping some cash for if and when things turn, they'll be able to survive into the next cycle and take advantage of those higher than average earnings in the next cycle, right? So I also like to see that if they have a lot of this excess capital during these downturns, they might use that to initiate buybacks during lean times to buy shares at lower than their intrinsic value. They may use this to maintain dividends during lean times, Or one thing I really like to see is that they expand their business against their competition during bad times. So those companies that had high debt, that have a lot of assets or whatever it may be, that are struggling to survive, maybe they'll just go and buy those companies or go buy their assets, go buy their ships, mines, whatever, right? So I really like to see this one. And this might seem like a no-brainer, but it's not always the case that the management does what you think that they should be doing. Okay, so now we're going to get into 5 points, I guess, 5 tips for investing successfully in cyclical stocks. We're going to start with Peter Lynch, and I think he breaks it down very eloquently.
Cyclical companies rise and fall with the economy. Typically, they make expensive big-ticket items that people buy when the economy is good. Things like houses, cars, and furniture. When the economy is bad and people are worried about losing their jobs, they don't buy big-ticket items. They're too broke or too scared that they will go broke. Don't try to time a cyclical stock if you don't have intimate knowledge of the business, if you don't have an investor's edge. Everyone on Wall Street tries to time cyclical stocks too. Because the stock market looks forward, you could be left with a sinking stock even though the company's earnings are terrific. You make your best money in a cyclical when earnings go from rotten to mediocre, or from mediocre to pretty good. The danger point is when earnings go from great to spectacular. Somewhere between these 2 points, Wall Street will figure out there's only one way to go, and that's for profits to go down some point in the future. Just don't buy in the hope. Wait for things to get better, prices to get better, capacity to shrink, inventories to go down, scrap prices to get better. Something ought to be happening. So you just want to wait for something really to happen, and then when it happens, it's going to be big. Let's take a look at Chrysler. In 1990, the company was selling for $10 a share. The economy was lousy. People were talking about Chrysler going out of business. But guess what? The economy came back. Everyone's old car was falling apart. As people made more money, they started buying new cars. And because Chrysler had great products, the minivan, the Jeep, and its first new full-size truck in 20 years, the stock was big. And in addition, very importantly, the balance sheet was decent in 1990. This was not a company about to go bankrupt. If it's a cyclical, you're hoping for a dramatic turnaround in earnings. It's going to happen over 2 or 3 years. Earnings are going to go from a loss to a huge profit. Stock's going to go up and you're going to get out. Make sure you're picking a strong company that can survive when the cycle goes down. That means good cash flow and low debt. If its cash flow is spotty or its debt is high, when the downturn comes, the company faces the danger of going bankrupt.
Okay, point 1 I'd like to make is a quote from Peter Lynch. It's to know what you own and to know why you own it. So one of the things that I've noticed very recently, through some of the comments, through some of the people I've spoken to, I know personally, is they're getting interested in something called uranium. Now, if you think about that, uranium is something that is out of the purview of most people's scope of confidence or scope of knowledge, right? A lot of those people are asking me about uranium. I don't know anything about uranium, right? So for me to go and talk about that commodity or buy something in that space, it would make no sense. And if you are a new investor and you're getting involved in something as niche as uranium, you should probably be very careful. It's a very difficult to understand industry, right? So, like a lot of industries, right? Now, I don't have a problem with people going out and purchasing that, but I do have a problem with people going out and buying that if they have no idea what they're doing, right? So what I would do and what I do is I learn about everything that I'm involved in. And I think that there's a lot of value in learning these different industries. Now, you can go and follow conference calls. You can read about, this is the information age. There's information everywhere. So it's really not that hard compared to times in the past to learn all about anything that you're interested in, whether it be copper, the auto industry, any commodity, whatever, right? So some point I'd like to make here is that nothing you learn is a waste of time. Patterns apply everywhere. So for example, I've learned a lot about the commodity of copper, and I've learned a lot about shipping. Recently, I've kind of noticed a couple of patterns because I know both of those. And that is in terms of retail sales. So I've noticed that because there's been a lot of stimulus in Western countries, I believe that this has led to higher than average spending. And because they weren't, a lot of people in Western economies weren't able to travel, it's led to a lot of spending on technology and discretionary goods that use high amounts of copper, right? So what I believe that has led to is a lot of people going out and buying computers, new cameras, microphones, starting YouTube channels, much like myself, right? Because they've been locked at home. And that what that has led to is an increase in copper demand, and has also led to an increase in shipping. If you look at container rates, they're just through the roof. And if you look at container stocks, they're through the roof. Now, if I had come up with this a little bit sooner, I might be have made a lot of money, but oh well, maybe I'll play the next cycle, right? Everything you learn has value, and it's going to apply to other things, even if it isn't profitable in the thing that you're learning, right? If you know not to invest now, like I know not to invest in container ships, you're going to know through learning the process enough to invest later. Like, for example, if you want to learn about uranium, great. And it might still be a great investment. I don't know. Okay. I think what I wrote down here, the pay to play, what I know a lot of people do, it's very hard for them just to go out and learn these kind of things. They need some kind of a motivation. So what I would suggest, and this is something that I do as well, is that you build a very, 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 very tiny position. So you put a certain amount of money into something that you're interested in learning about, and you just leave it there. And what that's gonna, but for me, and I think what it'll do for a lot of people, is that kind of incentivizes you. You're like, oh frick, I bought this company. I don't really know what's going on with it. Maybe I have it went down 5 or 10%, or it up 5 or 10%. What should I do? And then what that's gonna cause you to do is it's gonna cause you to go and learn more about it. And as you learn more about it, you're either gonna decide, holy crap, this was a bad idea, or you might find some other companies in that sector that make a lot more sense, and you're gonna develop through the process. So much like poker, this is kind of what I think incentivized me to come up with this strategy. You go through these different stakes. When you're first learning how to play poker, you start off at the smallest of stakes, and as you get better and better, you move up stakes. And I think that that can be a successful strategy for cyclical investing. Just and this isn't investment advice, this is just what I would do. I put a very small amount of something into something, and that's going to be an incentive for me to learn it about that. And maybe I'm going to lose a little money, or maybe I'm going to make little money. But as I learn that, there's the tremendous opportunity to build wealth at a later time. Okay, this to me is kind of the hardest part about cyclicals, and that's valuations. And I watch a lot of YouTube channels. I go and I find some very unknown creators, much like myself. I go and see what they think about different things. And there's a lot of channels where they do certain valuations on different things. And what I find about the cyclical industries that I know a lot about, when I see them valuing them, I cringe a little bit inside, because I know traditional value metrics, they don't work for cyclicals. Okay, so point 2 is to find a valuation system that works for your stock and industry, and it's going to change on the type of cyclical you are investing in. Okay, you cannot value cyclicals much like a non-cyclical business. If you look at a PE ratio, you look at cash flow, earnings, whatever it may be, there's a lot of different ways that you can value a stock. If you're valuing a cyclical much like you would a traditional business, you're going to run into problems. Okay, and that's because earnings can be erratic depending on where you are in that cycle. If there has been high earnings for a long period of time, and then the stock price has plummeted, probably because the Wall Street or whoever is starting to realize that, okay, the earnings are coming off. There's still going to be periods where the earnings look good for a few quarters or whatever, because of the commodity prices or lag or whatever it may be. And the PE ratio is going to start to look really, really nice. You might have a stock that's trading at a PE of like a 1. And you're like, holy crap, what is going on here? This is the cheapest stock ever. But you'd be absolutely wrong. It would be the most expensive stock ever. You have to cyclically adjust. You have to normalize earnings to really make sense of a lot of cyclical stocks. Many cyclical businesses rely on an underlying commodity as well. And that price can be volatile and it can be unpredictable. If you look at a company like Exxon, for the last decade, a lot of their earnings have been not as good compared to historical earnings, largely because of the shale industry and most oil companies around the world, right? So if you had valued these companies on an increasing oil price, you would have been wrong, and it would have been something that 100% of people probably would have got wrong. These companies are valued based on something that is inherently unknowable, right? This is why knowing what you own is very important, because of these two reasons, and you can't value cyclicals like some other businesses. Now I'll show you some ways that I look at valuing cyclicals, but I think that it can change based on what you're trying to value and what industry you're in. Okay, to kind of expand on this difficulty, this is a company that I am interested in investing in. It's something that I bought before, but I've sold I bought somewhere down here after the crash. I thought it was extremely undervalued, and I've sold it. But I'm probably at some point going to purchase this again in the very near future, maybe. But this is Methanex. They produce a commodity called methanol. This company is very difficult, okay? Because not only is this company based on the business cycle, which you can see from certain periods of time, but there are cycles within the cycles. There are cycles that are based on commodity pricing. So they produce a commodity called methanol, and they can produce it at, compared to a lot of their competition, they produce it at rates that are cheaper than a lot of their competition. Not all, but there's a lot of demand for methanol, and they can produce it cheaper than a lot of their competition, right? But what you can see here, the price of methanol is just all over the place, this orange line. You can see that there is a correlation with it with oil. If you look, there's a pattern here as well. Methanol is largely based on natural gas prices, which also correlates with oil. The demand has been increasing over time. And I think if you look at this very carefully, it might be hard to see here, but there is a small pattern of this company retaining value over time, right? Now, what makes it difficult is that these earnings go all over the place. There's so many moving variables, right? So you really have to have a system that can make sense of these things, all of these moving parts in terms of valuation. By the way, this down here is the earnings for this company through their different cycles. One of the tools I like to use for valuing cyclical companies is the CAPE ratio. So this is the cyclically adjusted price to earnings ratio. So what a lot of investors do to make sense of a lot of normal businesses, they'll use a kind of a price to earnings ratio. This is a way to kind of use that same tool, but for cyclicals. And what we're doing with this CAPE ratio is, because there's so much volatility in earnings, we're normalizing earnings over long periods of time. So we can see, based on knowing that there's going to be periods when there's very high earnings and low periods, we can kind of adjust those and make a long scale average. Okay, so what we're looking at here is the cyclically adjusted price to earnings for that last company I was talking about, Methanex. And you can notice, and you can compare this to some of their competition, their PE during certain periods of time make it a screaming buy. And there are certain periods of time with this CAPE PE when there's certain periods of time when it's a screaming sell, right? So I like CAPE for a lot of cyclicals to look at them at a glance, okay? This isn't a end-all be-all tool. It has its problems, okay? First of all, this tool assumes that multiple cycles are short enough to fit within the CAPE ratio period, whatever that may be. It doesn't have to be 10 years, by the way. But whenever time period it is in, you're assuming that there are clear enough cycles that you can cyclically adjust. Sometimes you're not going to have a cycle within 10 years or whatever the period of time that you think you could create something like this in, right? A clear example of that is the frontline stock, right, that we mentioned. There was a period of time where it had tremendous earnings for a long period of time, and then for the last decade or so, it has historically had shite earnings compared to the past, right? Okay, so I prefer to use CAPE for most companies because of its simplicity, and it's a simple way to value companies. It has its flaws, and like I mentioned, largely due to the variance between cycles. It also is assuming that these cycles take place in similar time frames, which might also not always be the case, right? Okay. And additionally, sometimes there are just these cycles that happen outside of the purview of these normal cycles, like the cycle that took place from 2003 to 2008 with a lot of commodities, or these super cycles that can occur infrequently. Okay, for some industries, one of the tools you can use to compare some companies are the net asset value. For example, in tankers, I've talked a lot about them in this video. A lot of the tanker experts out there, they don't use earnings, they don't use any of those things because earnings have been so bad for so long. How do you even use a CAPE ratio or something like, how do you even normalize earnings, right? So instead, you value the company based on their assets. What do they own, right? So the net asset value is their assets minus their liabilities divided by their total number of outstanding shares, right? So if I can buy a company that their total assets are worth more than the current share price, that is usually an indication to buy, especially during what is likely a cyclical downturn, right? Now, the thing that this has its problems too, just like CAPE, right? What happens in a lot of these cyclicals, the assets values fluctuate too, right? So during good times, these assets value go up because a lot of people want to own those assets because they're producing cash flow, they produce profit. But during bad times, these assets go down in value because they are cash flow negative, they're deteriorating, they're losing value over time, right? But if you're using this to value a cyclical or a commodity, like you can use this to value how much proven oil reserves a company has, right? Which is a depreciating asset. You could measure this, especially during the downturns when in the oil market. You could use NAV to see if that an investment in that makes sense compared to some of its competition. Okay, I like the last two ways I mentioned for valuing commodity companies or valuing cyclicals, but there are other ways to do it. Okay, this guy here, Aswath Damodaran, I'm learning some of the ways that he values these kinds of companies. But I'm not extremely confident on teaching those in this video, and I probably wouldn't be able to do it in a sufficient time span, okay? But essentially, just like we talked about with the CAPE, you can normalize incomes throughout a cycle based a lot on operating margins. So if we think about a company like Toyota that has operating margins, and we compare that to some of their other competitions, we can use that to provide a clearer picture and use that to normalize earnings over a long period of time, right? What he also does is he kind of runs these simulations. So because we don't know, or because it's so difficult to predict where a commodity price is going to be at any given time, you can run simulations to kind of assume a range of prices for a commodity, and then use that to base a probability of a certain valuation for a cyclical company, much like you can with Exxon, right? So I'm going to put a link to a paper that I'm reading, that I'm learning more about from this guy, Aswath, who, by the way, is a famous finance professor at NYU. Okay, so the thing is, no matter how you value a cyclical company, this is going to depend on your knowledge of the sector, right? So not all cyclicals can fairly be valued in the same way. All right, so the point three I would like to mention, especially with cyclicals, but in probably a lot of things, is to understand that the media is usually wrong and that you can exploit them. You can use them as either a buy or a sell signal, right? Now, this is one of the things I disagree with Peter Lynch on. One of the things he says is that the market is forward looking, right? A lot of the people on Wall Street, like, for example, if they know a cyclical is about to go bad, they'll sell out. I don't really think that that is true for most people most of the time. I think what a lot of people do is they project how things are now and they project them out into infinity, right? And if that wasn't the case, then how would you possibly see these kinds of share prices and these huge kinds of fluctuations, right? If people were forward looking, they would understand and they would do a lot of the things like Aswath would do to value cyclicals. They would normalize the earnings over long periods of time and then based the price of the cyclical on those things. But that's just not what the public does. They get in when the earnings are great and then they get out when the earnings are bad, right? So in any case, I wanted to show you this video that kind of, and a cyclical we're going to look at in a second, that is a very clear sell signal from the media.
Can I rent a tanker for a week from the biggest fleet in the world, from your fleet? I'd like a week. Can I have it?
You can have it, but it will be very costly. I doubt if you can afford it, but you can have it. We are making a lot of money at this time, improving our balance sheet tremendously. And I have never seen such a strong market, Jim. And I've been around for a little while.
All right, so how much a day for a nice one? Give me a Suez Max. How much a day?
Well, it will cost you $70,000 a day, and you will have it for 6 months. And our operating costs are $8,000 a day. And then you will have more than $60,000 a day for your pocket. And this will give you a lot of dividend.
So let me understand this. On Tuesday, someone was going to pay to give away oil, $37 a barrel. Why didn't I just contact you, let that guy pay me a lot of money for oil, and then give it to you?
Well, we don't speculate in oil. We speculate in carrying oil, and that's a different story. And my point is that I prioritize dividend. That is the thing. And I don't take risk I don't have to take. We have a strong market, and this is the strongest market I've seen in my lifetime. And I've been around for quite a while.
Okay, so this is Nordic American Tankers. This is the company's stock that was talked about in that video that you just saw. So this video aired on April 24th on CNBC. And during this time, there was just an absolute explosion in earnings, like mentioned previously, right? But like a lot of cyclicals, these things only last so long. In this case, this was a very, very, very short-term blip in the tanker market. And that if you had bought in here, you would have lost approximately 2/3 of your investment, right? Eventually, people caught wind that this is only going to be a temporary event. Oil demand is going to be sour for a long time, and a lot of people sold out, right? So what the media does, they don't understand the cyclical nature of an investment in many cases. They see something that has astronomical earnings for a certain period of time, and just like I mentioned, they assume that that's going to go on indefinitely without understanding the structure or the inherent properties of that business, right? Now, I would assume Kramer would understand these things, but he knows what a lot of people want. They want these kinds of things. They want to be sold on these things. They want something spectacular. They want things with incredible earnings, right? But in a cyclical, you have to be very careful, right? When the media is saying to buy, that's usually the time to sell. And the flip side is true too, right? So there's been periods of time where the media says what a horrible investment something is. So at the same time, which is very odd during this time, if you look at a lot of oil companies, they were saying what a horrible business oil has been over the last decade without understanding the dynamics or what has driven the oil industry over the past decade, which has largely been driven by this excessive buildup in American shale, right? So they project that and the COVID environment to be a permanent destruction, especially with the green narratives that permeate so many people out there. They perceive that as a permanent decline or a secular decline in the oil industry, which is completely false. And you can see that now a year later when a lot of oil companies are having record profits. Okay, point 4 I wanted to make is managing your emotions. And this is like, okay, come on, I get it. This is obvious. But I really think this is probably one of the biggest deals on how to be, I believe, to be profitable in cyclical investing. You're going to observe patterns in other people, first of all, right? So just like you can see these kinds of patterns of euphoria, especially in the media outlets, or despondency and depression on the media outlets when they talk about how terrible of an investment something is. You might also see some of these things, these behaviors in other people. You might see these on stock forums. That's a lot of the reason I like to go and read these things. Yeah, sometimes they provide some value to me, but I really like to observe people. I like to see where I think a lot of people are in their emotional cycles. And the thing is too, although you might feel like you are better or you have more control than other people, the truth is you're going to feel a lot of the things that they're feeling too, okay? You're going to feel when the stock price goes down after you buy in, you're going to feel denial, no matter how awesome you think you are, you're going to fear the desperation, you're going to feel panic. But the trick to this is you can't let these emotions influence your decisions. You have to kind of have a game plan. You kind of have to know, okay, if this is going to go down a certain point, then I'm going to do XYZ decision, right? And the flip side is true for me. I don't know. That's probably not true for everyone. And then when the flip side is true, when everybody's super ecstatic about this, you kind of have to find a way to divorce yourself from the emotions too. And that can be equally as difficult. How do you sell when everyone around you is so excited? That is, to me, that's one of the hardest things, right? For me, what I think the way I can manage these things is largely has been through experience. So I've played a game called poker, and I played a lot of tournament poker. And the thing about poker is that no matter how good you are, no matter how awesome you think you are, you're going to lose. It doesn't matter. You can be the best poker player in the world. No matter how good you are, sometimes you're going to lose. And if you are playing tournament poker, you can lose for very long periods of time, even though you have a winning strategy and winning temperament and all these kinds of edges on your opponents. Things are gonna go wrong, and when they go wrong for a really long time, you get beat up. Okay, you feel these emotions. You start to doubt yourself. You're like, was this a good decision? Why did I do this? You're gonna question yourself, right? And the flip side is the opposite of that is true. When you're doing very well, you don't tend to criticize yourself. You don't think, oh wow, I'm playing. I made a bad decision, or the opposite, right? You tend to think, oh, I'm the best. You know, I can't make I shit gold. There's nothing I could do wrong, right? So, I think a lot of learning to manage these emotions actually comes through experience. That's why I mentioned that kind of pay to play before. You really got to feel these things. You really have to be able to go through these things, notice where you are in your own emotional cycle, and compare that to others, and you'll kind of say, okay, I know what's going on here. I've been here before. I've gotten kicked to the curb. I've gotten beat up, or I've been as ecstatic as I've been over here. And I know, okay, I'm not going to let these emotions influence me. Instead, I'm going to use logic I'm going to try and use to influence my decisions. Okay, so this is the last point I wanted to make. And you need to find a buying and selling strategy that meets your temperament. So if you understand how your emotions work, you can understand your risk tolerances and stuff, then you can start to develop a buying and selling strategy. Now, I do think that these should be used in tandem with your valuations. You shouldn't just buy and sell something without thinking about the pricing thing that we talked about in step 2, right? So these are some of the common ones that I've noticed in terms of cyclical investing. There's some people out there that just they don't they can handle anything, and they just go lump sum. They say, okay, I'm gonna invest, I don't know, 10% into this oil tanker company, and that's cool. I'm just gonna leave it there and I'm gonna forget about it, right? For me, that's very hard, but a lot of people they're out there, they can do this and they can manage their emotions with this kind of decision. And that's, if you can do that, I think that's fine, right? This has the highest risk, but it also has the highest reward potential, right? So if your timing's bad, you're going to lose a lot of money. But if your timing's very good, you're going to make a tremendous amount of money with this strategy, right? This is probably one of the ones I tend to do most with cyclicals, and that's that I tend to try and dollar cost average into a position, right? For me, if I buy into a stock and it goes down 20%, that really is hard for me. Okay, so what I like to do is I like to buy something and just buy a little bit at a certain period of time, and then over another couple of weeks or a month, I'll buy a little bit of more, right? So if we know that the cycles go through these certain periods over a period of time when they're low, and they go through these certain periods when they're high, if I'm able to DCA into a position through what I think is likely to be a certain duration of a trough, I can handle that a lot better than I can with this lump sum investing strategy, right? So for me personally, I like to buy and sell over weeks and months. But this is, I believe, lower risk, but it is also lower reward, right? So you're probably going to get an average closer to the low, but it's not going to be all the way to the low like you could get with the lump sum. And you can get an exit that is closer to the high, but is not all the way the highest amount that you could get for selling at the peak, right? I do know that this is the theoretically optimal way to do this in terms of at least buying. I'm not sure the theoretically optimal way to sell, but I know that in terms of buying cyclicals, the optimal way to average down is to buy when a certain amount and then only average down after it has fallen by 50%. This is a mathematical thing. I don't know exactly why this is true. I just know that it is. The optimal way to average down, if you are purchasing a stock, is to buy something and then only average down if it goes to 50%. The thing is, I'm not sure if that's the case with selling. For me personally, I'm looking for multi-baggers if I'm playing cyclicals because of the inherent risk in these things, right? So if I'm only going to, sell when a stock has doubled, it's limiting a lot of the upside, especially in these very risky industries and stocks, right? I'm looking for, these 3, 5, hopefully some 10 baggers out there, right? Okay. The thing is, finally, when you're thinking about buying and selling, like I mentioned, in poker, there's something called variance. The same is true in investing, right? So no matter how confident you are, no matter awesome you think you are, no matter how much you understand something, I feel super confident in oil tankers, by the way, so much so that I feel like I can be arrogant compared to maybe at least some retail investors out there. No matter how confident you are, you need to be able to manage your position sizings. You cannot just bet 100% on a single idea and say, good, right? It may work out, it may be awesome, but chances are, especially if you do this repeatedly, you're going to end up completely broke, okay? We've seen what some of these cyclicals can do on the downside, right? Especially if your timing is wrong. So for me, what I try and do, so there's some people who can tolerate a little bit more risk than this. I think that's extremely risky, and probably has the potential to be a losing strategy in the long run. No matter what, I won't tie up more than 10% of my total portfolio into any idea. And there's going to be a certain point, no matter how I'm buying these stocks, I'm going to have to put a cap on it. So let's say I buy something and it goes down 50%. Okay, I'm like, okay, fine, that's fine. I can buy more, right? But if I buy something and it goes down another 50 and another 50 and another 50, and I average down at each of these intervals, there's going to be a certain point when I'm going to go broke, right? So you need to have a capped position size. And if it doesn't work out, that's okay. The thing is, you know, for every one of those that doesn't work out, there's going to be some that do, right? If I have one position that goes down 50%, but I have another that doubles, and I have another that triples, and I have another that goes 5x, it doesn't matter that this one didn't work out, right? It's a long game. I'm going to get some wrong, and hopefully I'm going to get more right, yeah? So be sure you have a you have appropriate sizings to your investments, and you need to be okay with losing sometimes. Okay, so these are my closing thoughts. This is something I've been thinking about. I don't know if it pertains to the guide, but I don't know. I just thought I wanted to add it. So one of the questions I have when I think about these cyclicals, and by the way, I almost didn't want to make this video first because I feel like I'm giving away some of my personal knowledge. But I mean, if you look at all of this stuff that I'm sharing, it's stuff that a lot of people know. There's nothing proprietary about what I'm sharing with you guys, right? So the thing is, you know, if we know all of these cycles happen, we know that, you know, if if I buy when things are looking bad in cyclicals and sell when things are looking good, why isn't everybody doing that? Aren't these share prices normalized, right? So the question I kind of wonder and I think about is, why do these cycles persist? So this is an Indian proverb. It says, life is a cycle. It's always in motion. If good times have moved on, so will times of trouble. And the same is true with a lot of these cyclical stocks. I think what a lot of this is just human nature. I think no matter what happens, people get stuck in wherever they are in their cycles, or wherever they are in their sociological cycles, what's happening around them. And it gets very hard to divorce yourself from what's going on around you, right? So I think why these cycles persist, I think that they are just a part of human nature. And you know, when I was thinking about sharing this stuff, I was like, if it is an intrinsic property to human nature, it doesn't really matter if I share it. The thing that is going to determine someone's success or failure in these kinds of cycles is being able to divorce themselves from those behaviors, to understand them, and to really separate themselves from them. Anyway, I hope this extremely long educational video was of use, and I'll see you guys soon.